Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Magna International is the world's most diversified automotive supplier. Founded in 1957 by Frank Stronach in Toronto, it has grown into a company with 172,000 employees across 28 countries.
What sets Magna apart is breadth. Body structures, seating, electronic vision and parking systems, thermal management, and complete powertrain components, all under one roof across one global supplier.
The largest segment, body exteriors and structures, generates roughly 39% of revenue. It covers stamped metal panels, door systems, front-end modules, and the structural components that define a vehicle's shape.
The power and vision segment is nearly as large, covering camera systems, driver assistance hardware, mirrors, lighting, and increasingly electrification components for battery electric vehicles through Magna's eDrive systems.
Then there is Magna Steyr, the contract vehicle manufacturing arm. Magna Steyr physically assembles complete vehicles on behalf of automakers. No other supplier in the world offers this capability at comparable scale.
Magna Steyr currently assembles vehicles for BMW and Mercedes under long-term contracts. It allows automakers to launch lower-volume models, niche variants, specialty EVs, without the capital cost of a dedicated factory.
Magna's customer diversification is a real structural advantage. No single automaker represents more than roughly 25% of revenue, which reduces exposure to any one OEM's production schedule or financial health.
On electrification, Magna formed the LG Magna e-Powertrain joint venture with LG Electronics in 2020. This JV produces EV traction motors and inverters, positioning Magna as a key Tier 1 supplier as EVs scale.
The EV transition is a double-edged sword for Magna. Electric vehicles carry higher content per vehicle, more complex electronics, thermal systems, and specialized seating, which expands the revenue opportunity per car built.
But the pace and timing of the transition created near-term margin pressure as production volumes shifted and customers adjusted EV launch schedules. Magna's margins have been compressed during this transition period.
CEO Swami Kotagiri took the helm in 2021, promoted from within after serving as Chief Technology Officer. His background is deeply technical, which is fitting for a supplier navigating a technology-driven industry transformation.
Magna has paid and grown its dividend for over 15 consecutive years. At roughly $1.84 annually, it reflects the company's consistent free cash flow generation through auto cycles.
Peers include Aptiv, Lear Corporation, and BorgWarner. Among them, Magna is uniquely diversified across the most product categories and is the only one operating a full vehicle assembly business.
The thesis on Magna rests on engineering to production depth, the ability to take a concept from design through to a finished vehicle. That breadth of capability across product categories is genuinely hard to replicate.
That's the company chapter for Magna International. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Magna International just posted a dramatic Q1 comeback. Adjusted EPS of 135 versus estimates of 101, a 33.7% beat. Revenue of $10.13 billion came in essentially in line. This follows a catastrophic Q4 2025 that included a restructuring write-off. The bounce-back signals operational recovery is real. Magna is the world's most diversified auto supplier, navigating tariff risk and EV transition headwinds. This is Charged Alpha. Let's break it down.
Magna International is the world's most diversified automotive supplier. Market cap $17 billion. Magna makes virtually every major non-engine component: body and chassis systems, powertrain, seating, vision systems, mirrors, and electronics. Major customers include General Motors, Ford, BMW, and Daimler Mercedes. The diversification across products and customers is Magna's primary competitive advantage. No single program risk can derail the company. Magna also assembles complete vehicles for European OEMs, a unique capability that adds contract manufacturing revenue. The business generates revenue proportional to global vehicle production volumes.
Q4 2025 was a write-off quarter in every sense. GAAP EPS was essentially break-even on restructuring charges. That created a very low bar for Q1 2026. Magna cleared that bar by a wide margin. Adjusted EPS of 135, 33.7% above the 101 estimate. The adjusted figure excludes restructuring and one-time items. The operational business recovered meaningfully from the Q4 trough.
Revenue of $10.13 billion came in essentially in line with the $10.14 billion estimate, a rounding difference. The revenue stability is notable given tariff uncertainty and production volatility at major OEM customers. Prior year comparison, Q1 2025 revenue was $10.07 billion, nearly flat year over year. This is a business whose top line tracks closely to global vehicle production. With production volumes roughly flat, revenue consistency is the expected outcome.
Margins remain the core challenge. Net margin on a trailing basis is 2%, thin even by auto supplier standards. Gross margin is 13.2%. Operating margin is 6%. These are the structural realities of being an auto supplier. Massive volume dependence, customer pricing pressure, and high fixed cost manufacturing infrastructure. Magna's advantage is that it is the largest and most diversified supplier, giving it more pricing leverage than smaller peers.
Cash generation provides more comfort. On a full-year basis, operating cash flow is $2 billion. Free cash flow is $1.3 billion. Q1 cash flow was lighter, as is typical seasonally. Cash stands at $1.6 billion against total debt of $8.3 billion, significant leverage that management is actively reducing. Equity of $12.5 billion provides a substantial book value floor. The restructuring charges in Q4 2025 were designed to reduce the fixed cost structure and improve margin trajectory entering 2026.
The geographic dimension of the Q1 result matters. North America remains the highest margin region for Magna, given its deep customer relationships with GM and Ford. Europe was softer. German auto production has been under sustained pressure, but Magna's BMW and Daimler exposure in Europe is partially offset by the company's flexible manufacturing model, which allows it to shift production volumes across platforms in response to OEM scheduling changes. Management reiterated confidence in the full-year margin trajectory on the earnings call, citing restructuring savings tracking ahead of the internal plan. Magna trades at approximately 9 times forward 2026 earnings at 60.83 per share. The 52-week range of 32.55 to 69.94 tells the story of a stock that was deeply distressed mid-cycle and has recovered sharply on the Q1 EPS beat. 9 times forward PE is at the high end of auto supplier historical multiples, typically 5 to 10 times, and reflects the market pricing and margin recovery.
Peer context: Lear Corporation, LEA, trades at 5 times forward, Borg-Warner, BWA, at 7 times, Aptiv, APTV, at 8 times, Autoliv AP at 12 times. Magna at 9 times sits in the middle of the peer range. The auto supplier sector uniformly trades at low multiples, reflecting low margins, cyclicality, and EV transition uncertainty. Magna's diversification and complete vehicle assembly capability justify a slight premium to pure-play peers.
The tariff risk is a real valuation overhang. Magna has significant manufacturing operations in Mexico and China, both major tariff targets. If import tariffs on auto parts from Mexico escalate, Magna's cost structure is directly impacted. Management has quantified the tariff exposure as a meaningful headwind to second half 2026 margins if rates remain elevated. This uncertainty is the primary reason the stock trades at 9 times rather than 12 to 14 times.
3 reasons to be bullish on Magna. First, operational recovery is real. The Q4 2025 restructuring was painful, but it was designed to reset the cost structure. The Q1 adjusted EPS beat at 135, more than double Q4's near-zero result, signals the recovery is ahead of schedule. Second, EV content opportunity. Despite EV transition uncertainty, Magna's electronics and e-systems businesses carry higher content per vehicle in EVs than ICE. As EV penetration grows, Magna's revenue per vehicle grows. Third, Valuation at 9 times forward is undemanding for a global auto supplier with $2 billion in annual operating cash flow and diversification no smaller peer can replicate.
3 reasons for caution. First, tariff risk. Magna's Mexico manufacturing represents a material portion of North American production. If U.S. tariffs on Mexican auto parts escalate to 25% or above, Magna faces either absorbing margin compression or attempting to renegotiate costs with OEM customers. Neither is easy. Second, auto production cycle sensitivity. Global vehicle production is tracking flat to slightly negative in 2026. If OEM production cuts accelerate, driven by tariff-induced demand destruction, Magna's top line declines proportionally. Third, net income margin at 2% provides almost no cushion. Any cost shock, commodity inflation, tariff-driven input cost increase, or labor cost step-up could push reported earnings to near zero, as Q4 demonstrated.
The auto supplier peer group is uniformly valued at low multiples. Lear at 5 times forward, BorgWarner at 7 times, Aptiv at 8 times. All face the same structural headwinds: OEM pricing pressure, EV transition uncertainty, and tariff exposure on cross-border component flows. Magna's differentiation versus the peer group is scale and diversification. Lear is concentrated in seating and electrical. BorgWarner is concentrated in powertrain. Aptiv is focused on electrical architecture. Magna makes all of these products and more. The breadth is the moat.
On a revenue basis, Magna at $42 billion in annual revenue dwarfs any single segment peer. The complete vehicle assembly business, where Magna manufactures entire vehicles under contract for European OEMs, is a capability that simply does not exist at Lear, BorgWarner, or Aptiv. That differentiation brings a category of revenues and customer relationships entirely absent from the peer group. In a down cycle, Magna's diversification spreads earnings across more products and geographies than concentrated peers, providing relative earnings stability. Options activity on MGA was modestly bullish ahead of the Q1 report. The put-call ratio ran approximately 0.8, slightly bullish bias, but with meaningful hedging reflecting tariff uncertainty. Post-earnings, the stock rallied on the beat, and call buyers were rewarded. Implied volatility on MGA is elevated relative to historical norms, reflecting both the earnings uncertainty and macro tariff risk that are difficult to model. Short interest runs approximately 6% of float, meaningful but not extreme.
Insider activity is a key signal for Magna. Following Q4 2025's restructuring charge, several members of the management team made open market purchases, a constructive signal that internal conviction in the recovery trajectory was genuine. Institutional holders include Vanguard and BlackRock, which hold the stock across broad market index funds. Active management holders have trimmed positions during the tariff uncertainty period, creating some selling pressure that the Q1 beat may partially reverse. Bottom line on Magna International: the 33.7% adjusted EPS beat marks a decisive operational recovery from the Q4 2025 restructuring trough. The EV content opportunity and diversification moat are intact. Tariff risk is real and must be monitored every quarter. At 9 times forward earnings with $2 billion in annual operating cash flow, Magna screens as a reasonable value for investors with conviction that the auto production cycle stabilizes and tariff risk does not escalate further.
Charged Alpha is produced for entertainment and education only. Nothing here is financial advice, and we are not licensed financial advisors. Always consult a qualified professional before making any investment decisions. Past performance does not guarantee future results. The hosts and production team may hold positions in securities mentioned. Trade carefully.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.